set of different bases in the kind of world most of us are familiar with. But importantly, he's also coming from Groningen. I'm not trying to speak it the Dutch way, in the north of the Netherlands, so not in Holland. And that's a special place because that's a place where a number of economists come from. Many of you know Willem Buiter and others, Bart van Ark, Jacob de Haan, who is now at the central bank in charge of research, but also Wim Duisenberg. So the fact that the former head of the ECB was from there may or may not be a sign that something to be left for later. So thanks a lot, class, for putting us on your schedule, and you now have the floor.
So thank you. I did have, yeah. Check. No. Sorry. Wrong way. Yeah. Okay. Now I know which way it moves. Okay. Well, thank you for having me here, Nicolas and others. And what I will do is I'll have a couple of prepared remarks where I will begin with. And these are on easy money, uneasy finance, the relationship between monetary policy and financial stability. And then afterwards, obviously, I'm happy to take some questions and we can further the debate. My starting point today is that 10 years ago, the financial system was on the brink of collapse. Within just a couple of weeks, well-known and systemically important financial institutions either failed or they teetered on the brink, on the abyss. Activity in several key financial markets ground to a complete halt, and soon after, the world economy would enter into a very deep recession. Well, to remind you of the extreme circumstances of that time, let me show you the front page of the Financial Times from 10 years ago. So this is the Financial Times of 24 September 2008. And you see that these headlines were dominated by the frenzied efforts of the US government and the Fed to deal with the fallout from the Lehman Brothers collapse. Well, we all remember probably the unimaginable developments that happened in those weeks. We probably also all remember the pain of the Great Recession that hit the global economy in the following years. But what I also remember is the global commitment and the cooperation among policymakers. Deep uncertainty was plaguing these authorities, but I think at the end of the day, a combination of extraordinary measures, including interventions, capital support, liquidity injections, all these interventions eventually succeeded in restoring financial stability. And an unprecedented monetary stimulus was provided through a range of conventional and unconventional tools. 10 years later, we now stand at vital crossroads. The supervisory reform program has made important progress. Monetary policies are now being normalized. So what I want to do this afternoon is to take stock of the current challenges. And I would particularly like to focus on the importance of a robust financial system for conducting monetary policy. And in doing so, I want to convey two main messages. First, that a sound financial system makes life for monetary policymakers much easier. It limits the effects of financial shocks on the real economy, it strengthens monetary transmission channels, and it also reduces the unintended consequences of monetary policy actions. Obviously, the reverse is also true. A weak financial system can cost central bankers many sleepless nights. Secondly, against the backdrop of an environment that is of a monetary environment that is likely to remain accommodative for some time, in my view, we therefore need to further strengthen the financial system. And to do that, we need to further improve the financial regulatory framework in the coming years. And I will argue that the current financial system is in much better shape than a decade ago, but that still important risks remain. I will argue that international regulatory authorities first need to maintain strict micro and macro prudential regulation. Secondly, must seek further improvements in policy implementation. And thirdly, should also adapt to risks shifted outside their perimeter. Let me briefly recall the financial, economic, and policy circumstances that allowed the global financial crisis to develop. In the decades before the crisis, the global system changed profoundly, and this was the result of deregulation, increasing competitive pressures on banks, and also increasing financial globalization. These trends have led to a greater role for market finance and a stronger interconnectedness within the financial system. During the same period, the macroeconomic environment also underwent structural changes. This happened on the back of accelerating globalization, the emergence of new players like China, and technological progress. Against this background, large global flows of savings and investments pushed down long-term interest rates in the US and other advanced economies. Accommodative monetary policies further allowed for financial risk-taking. It has been argued that this great moderation allowed a leverage build-up that ultimately threatened financial stability and hence macroeconomic stability. In the regulatory policy sphere, a widespread trend towards deregulation loosened the reins on risk-taking in the financial sector. Microprudential supervision was not well equipped to address this increased risk-taking. In addition, a macroprudential orientation of regulatory policy addressing systemic risk was almost completely absent at that time. In this environment, misaligned incentive prompted widespread risk-taking in the financial system, and in combination with high economic growth, important imbalances developed. When the crisis erupted, banks did not have sufficient capital to absorb losses, and authorities were not adequately prepared to handle failing banks. The imbalances spread almost instantaneously across the global financial system as a result of the interconnectedness of financial institutions and markets. Now, these patterns are not specific to the global financial crisis, as economic historians have documented. Typically, financial crises are preceded by booms where factors like high growth, innovation, and increased risk-taking interact. In a recent paper, however, Ben Bernanke added yet another element, and that was the excessive reliance of financial institutions on short-term wholesale funding. And this new element, I also believe, explains why the global financial crisis was more extreme and why it also had more severe effects on the real economy. When the crisis erupted, it was clear that we needed new policy toolkits. In the last 10 years, therefore, a comprehensive reform program has been developed under the leadership of the G20, the Financial Stability Board, and the Basel Committee on Banking Supervision. These reforms have made financial institutions better equipped to deal with future shocks. Thanks to these reforms, banks today hold significantly more capital, which is more readily and more easily available to absorb losses. Banks also have stronger liquidity positions, and they have strengthened their governance and risk management. Prudential policies increasingly include a macroprudential orientation with a stronger focus on financial stability. Risks originating in the shadow banking sector are better appreciated, and over-the-counter markets have become more robust and more transparent. In addition, resolution management has emerged as a new toolkit to address too-big-to-fail distortions. And it also became clear that traditional monetary policy responses were not sufficient to deal with the great recessions. As policy rates were cut to their effective lower bound, further monetary accommodation was achieved through unconventional tools such as forward guidance, longer-term refinancing operations, and asset purchases. And with the help of these new tools, monetary policy contributed to fixing a dysfunctional monetary transmission mechanism, to supporting the recovery, and averting deflation risk. Today, the financial system is more resilient, and the global economy is enjoying a period of strong economic growth. However, important challenges remain for both monetary and regulatory policymakers. A framework that I consider very useful for guiding policy actions is based on the following very simple 3 key elements. First, the necessity of policies. Do circumstances require action by authorities? Secondly, the effectiveness of the instrument. Can the proposed policies achieve the intended objectives? And thirdly, the possible unintended consequences of some of these interventions. In my view, both monetary and regulatory policies need to be based on such criteria as guideposts for policy making. Let me apply now this framework to monetary policy first and focus on the interplay with financial stability. And my main point here is that a sound financial system makes life much easier for monetary policy makers. Let me elaborate. First, a sound and stable financial system will reduce the need for monetary policy actions aimed at macroeconomic stabilization. The global financial crisis and the ensuing Great Recession have shown that shocks emanating from the financial system can have a devastating impact on the real economy. Similarly, a financial system experiencing stress amplifies the effect of shocks originating in the real economy. And both mechanisms then lead to larger deviations of output from potential, of inflation from target, compared to an environment in which the financial system had remained stable. And in turn, that then calls for more monetary policy interventions to stabilize output and inflation. Second, monetary policy is also more effective when the financial system is sound. Standard monetary policy determines the marginal financing conditions in the short-term money market. Its macroeconomic effects then depend on several channels through which financial intermediaries pass on these policy rate decisions to the real economy. Especially on my side of the Atlantic, during the European debt crisis, these transmission channels became severely impaired. And this severely restricted the ability of policy rate cuts that the central banks had implemented to stabilize the real economy. Central banks ultimately, as I said, had to resort to unconventional monetary policy tools to restore the pass-through of lower policy rates to firms and households. A sound financial sector, therefore, enhances the effectiveness of monetary policy by improving the functioning of the transmission mechanism. It helps monetary policy achieve its objectives with less effort, and it also reduces the likelihood that the effective lower bound is reached. Third, the more sound a financial system, the less likely it is that monetary policy will have unintended consequences. The converse is, of course, also true. A weaker financial system will make it more likely that monetary policy actions will create these unintended consequences. These unintended consequences can occur through different channels. The first and much debated mechanism is the risk-taking channel of monetary transmission. According to this, monetary policy has a systematic impact on ex-ante risk-taking in the financial sector by setting the universal price of leverage, affecting financial conditions and thereby ultimately the real economy. A prolonged period of loose monetary policy can contribute to the build-up of financial imbalances. And in this sense, and this is up for debate, but persistently low interest rates since the turn of the century have also perceived by some as contributing to the global financial crisis as well. A second mechanism through which persistently low rates affect financial soundness relates to the reduced incentives for balance sheet repair. The more so if macro and micro prudential regulation are insufficiently developed. And this is most evident in a crisis situation, such as the one from which we have recently emerged in the euro area, or, let's say, the crisis of Japan in the 1990s. Monetary stimulus through